Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning with this week's market breakdown video. Last week, we took a look at the major four U.S. indexes, and we talked about this pattern here on the S&P 500, how we had that major resistance, that 30-30 zone, and we had a series of higher lows that we've put in, essentially forming an ascending triangle pattern, meaning every time the market dips, buyers step in at a higher level, which typically ends up resolving itself to the upside and is a bullish pattern. Of course, in order for confirmation, we need that market over that 30-30 level. Now, basically nothing has changed since we made this video last week. The S&P 500 is essentially at the exact same level. We take a look into the NASDAQ. It's basically right there at that same level. We take a look at the Dow Jones. Same level as last week, same setup. However, we did have strength finally in the Russell. We made this video last week. I mean, the Russell's up about 2.5% since we made that video. But again, this index really has been trapped in between a 1450 to 1600 range. Hasn't even come close to making a new high since the middle of last year. Has been the lagger, the weakest of the week over the last 2 years in terms of the major U.S. indexes. So not a whole lot has changed technically. One of the things that we hear people talk about a lot in technical analysis is volume and volume confirming moves. So breakout on heavy volume is a good thing. And when things kind of drift up on lower volume, it may not necessarily be a good thing. A lot of that is misinformation, doesn't hold weight. And the information that we're going to cover today is actually taking a look at the low volume environment that we've had and what that's done in the past and what that could mean for us in the future. So this chart from Sentiment Trader goes back to 2014. We take a look at the total New York Stock Exchange volume on a 20-day average as a percentage of the market cap of U.S. stocks. And you'll notice where we are right now. It's the lowest in over a year. Really low reading. Essentially, we have moved higher as of late on very low volume as a percentage of the overall market cap of the U.S. stocks. So what has that meant in the past? Well, let's take a look at that data point. When we couple the low volume as well as the S&P 500 within a 1% of a 52-week high, and volume as a percentage of market cap at a 6-month low, and we take a look at this data going back to 1962, what we can see is within a short time frame, we're about even in terms of risk reward. And as we go out about 6 months to a year later, we actually have a bias here to the upside of almost 0.75%. And the upside risk versus the downside risk, when we look a year out, the downside risk is about 6%, the upside risk being about 11%. So really good numbers long term. We take a look at all the past instances of the data. Now, of course, the big zone here of negative was 2000. When we hit that top, a year later, the market was down 25%. But if we look at the percent positive and the returns, it's actually not a bearish thing. So stocks rising on low volume actually is counterintuitive. Actually does not mean when you look at the actual hard numbers as a negative thing. So I thought that was interesting, and that's kind of why I wanted to share that with you. There is a lot of misguided sayings in technical analysis, and one of the areas in which that appears a lot is actually on the volume side of things. So as I see interesting volume data points like this moving forward, I'll certainly take a look at that for you. Last thing I want to take a look at in this video is our breadth reading. So let's take a look at the NASDAQ. When we compare this to where we were last week, even though stocks haven't made much of a change, the NASDAQ McClellan Summation Index was about here when we looked at it last time. It has continued to head higher. We're almost at that zero mark. Really, any sort of follow through here to the upside would be bullish for stocks. We would get that technical breakout on the indexes. We'd have our breadth reading with the tailwind behind us above that zero zone, and that would be very nice. Now, of course, the catalyst to drive us higher here is earnings season, which we are underway. There have been some really interesting earnings surprises in both directions, to the upside and the downside, as of late. Guidance, same thing. Some companies have guided up, some have guided lower, and so it's been a mixed bag so far, and that's part of the reason why the indexes themselves have not moved so far this week. But as we continue to get further into earnings season, we have a lot of other major companies that will be reporting here. If we do see some sort of trend, either up or down, that could be the catalyst that we need in order to drive us towards that next market movement. So I hope you guys found this video interesting. As always, I look forward to seeing you guys next week. Take care.